Let's go to an expert now. He's Jay Bryson, Chief Economist of Corporate and Investment Banking at Wells Fargo. Jay, first of all, thanks for making time for us on a very important morning. What's your takeaway from these numbers? And most importantly, I guess, how do you think the Fed will digest this, given the blow-up of a bank in California just last week?
Well, so Paul, if we didn't have the blow up of a bank in California last week, I think the Fed would be primed to be tightening policy again next week. The big question would have been, is it 25 or is it 50? Now, given everything that's happened since then and things that potentially could happen between now and next week when they meet, I still think the jury is very much out on whether the Fed actually raises rates next week. I mean, everything else equal, I think they would like to, but just given all the volatility in markets, it may make them want to pause and just see how things are progressing at that point.
Is a pause conceivable next week?
Oh, I think it is conceivable. I mean, I think it's, the communications around that might be a little bit challenging. We've done, 9 consecutive meetings or 8 consecutive meetings now with rate hikes, and now you're pausing. I mean, what's going on here? So I think it would be a little bit challenging in terms of the communication, but given everything that's going on, I think the market would understand what's going on as well.
How do you think the failure of Silicon Valley Bank has changed the environment out there and changed the view, how things look to the Fed?
So what the failures of these banks is doing, it's tightening financial conditions, right? We've seen credit spreads in the corporate bond market move out. Obviously, the stock market has moved down. I would think, I don't have real-time observations on this, but I would think that lending standards at banks are going to be tightening, in coming weeks, and all that acts as a drag on the economy. And so, if you had kind of a dour outlook for the U.S. economic outlook heading into what happened last week, I think this makes it even a little bit more pessimistic as well.
Silicon Valley Bank was overextended on long-dated U.S. bonds, and when the run-up in interest rates from the U.S. Fed put pressure on the value of those assets, it was not able to sell them because it would get into capital trouble if it did. Does the Fed have to be mindful that further rate hikes could put similar pressure on other institutions?
Yeah, so I mean, the two big things that the Fed looks at, there's two big goals, is unemployment and inflation, but there's also a financial stability aspect to all of this as well. They look at that very, very closely. And I mean, let's face it, if the banking system in the United States collapses, we don't really have to worry about inflation in the long run, right? We have to worry about unemployment there. So it is something they have to be mindful of. But, again, I think they want to see how financial markets are reacting over the course of the next, week or so before we go into that FOMC meeting. If things settle down, they may feel emboldened that they can go by 25 basis points. But if we still have a lot of volatility at that point, then maybe they may decide that holding off is the best course of action.
Would you expect some commentary from Jerome Powell next week on the SVB situation?
Oh, well, absolutely. I mean, maybe not specifically targeted to that individual bank as well, but I think, he wowould lump it all into, the problems that we've seen at regional banks. As you were mentioning before we came to this show here, that some of the regional banks just got beat up yesterday in terms of their stock prices. So, SVB is one bank, but there's a lot of other banks out there that also have had some issues, in recent days.
Okay, let's step back and set aside the regional bank issue. Do these figures indicate that the Fed is making progress? We're now a year in from the first rate hike of the U.S. Fed, or very close to being a year in from the first rate hike. Is inflation coming down in the way that the Fed would like it, and will it continue to come down?
So yes, it's coming down. We've made progress, but we're still not there. I mean, the numbers that you were talking about earlier, that core rate of inflation, that 5.5% year over year, the Fed would like to see that at closer to 2%. So it's come down. We're chipping away, but we still have a lot of work to do to get inflation back down to 2% here.
How much it wasn't that long ago that Jerome Powell told the market that rates will have to move higher, perhaps faster and probably further than markets were assuming to tame inflation. Does the banking situation, to return to that again, must he change his narrative now?
Yeah, so I mean, that commentary was only last week, but now it seems years ago, doesn't it? But so yes, I mean, it does change the narrative. As I was saying before, we've seen a real tightening in financial conditions in the United States, and if it remains tight like this, that will be doing the Fed's job for it. You know, with credit spreads going out, with lending standards tightening, all those things put headwinds on growth in the United States, and they would tend to bring inflation down as well. So the point of all this is perhaps the Fed doesn't have to do as much as they did before, given what we've seen in terms of financial tightening here.